Hey guys, it's me, Charnel, and I wanted to shoot this video because I know there's so much uncertainty when it comes to growing your money, keeping more of your money, and really just understanding this wealth building game, right? A big part of that is compound interest. So many people wonder, is it really good for me? Is it magic, right? Is it only for the banks? Is some mystery that they have? Or can you really become a millionaire with compound interest? So what is interest? Interest is basically the cost of money. When you're loaned money or when you give the bank a loan, there is a fee that's paid on that money. So it's basically money on money. There's different types of interest. There's different variables that impact it and how it's calculated and how much gets paid out. So simple versus compound interest, these are two of the most common interest types that most people know about. So really quickly, simple interest is calculated daily. If you pay it off faster, you pay less interest. And it's based solely on the principal. So for example, a car loan, which is the APR type of loan, typically annual percentage rate, means that you can pretty much calculate the total amount that you're going to have to pay back for that loan from the beginning, okay? Now, compound interest works a little bit differently, even though it's still calculated daily. You pay less interest if you pay it off faster. And it's based on principal, but it's also based on the accumulated interest too. So from the previous period, such as a credit card, which is also still annual percentage rate, but what it does is it adds in the interest from the previous month onto your new balance, and then you pay interest on that. So it's basically paying interest on interest. So when you look at it in the real world examples here, loans versus deposits, what you'll see on this loan side is that when the bank gives you money, they get to charge you a whole lot more, bottom line. You'll see APR at the end of that. And then if you look on the share side, which is a savings account or the checking or the money market account, you'll see APY behind it, which is annual percentage yield, which means that's the money that you're getting paid for that. And you'll see there's a big difference. A lot of those are 1% or less. And everything on the bank side that they make money is 3% or more. And 3% is pretty low. And that's on a mortgage. So they're getting a lot more than 3% actually. So what's the truth about APY? So we saw those numbers and we saw that you might get 1% right now max at most banks, and that's a credit union, so it generally has pretty good rates. But what most people don't think about is that that's for the year. So that's actually divided by 12. This is an example of a savings account, and what you'll see here is that this particular account has an annual percentage yield of 0.11%, which means every month you're actually getting a 12th of that. This account for 31 interest-bearing days had almost $900 and only got 8 total cents. That means for the whole year, let's say this account went up to $1,000, but for the whole year stayed that way, you would only get about $1.20 in that account. So interest is either given or charged. If it's given to you, it's generally a reward or incentive for you to earn money so you keep your money there. It's because you are paid for loaning the bank money. But in that, you're giving the bank power to use it. So they're compensating you for that. For example, your savings account. Now, when interest is charged to you, it's how the banks earn their money in addition to their fees that they may have for the different accounts we have with them. It's the cost you pay for loaning the bank, for the bank loaning you money, excuse me. And so in that, the bank has given you money so you have the power to use it. So you can go buy a car or a home or shoes or clothes or, water heater, whatever that may be. And they collect additional money on top of that because they loaned it to you, giving you that power. For example, like I just said, a mortgage loan. They are two very different kinds of interest. Though they are one and the same, they're calculated very differently, and as you can see, the amount paid out is a lot different. So what does your bank say about the cost of money? This is an example of account, and I just wanted to show this because, as you can see here, most of the options, as you saw in the previous chart, give you less than 1% for the whole year, whereas a vehicle loan, or even double that, a credit card loan, is 8.25%, and that's a pretty good rate. Most people are in the 20% range with their credit cards, and so this is a modest viewpoint, but it's still quite a bit and it adds up quickly. And it's a very big difference from what you see up top that you get paid when you loan the bank money. This is an example, a real life APR example. So this means that a loan was given from the bank and they have charged a certain percentage rate. This is actually about a 14% loan, and it was on $8,000. And as you can see, the interest charges every month, or have been lately, are $83.97. Paying just the minimum payment of $120 means that you're putting less than $40 towards this principal amount. This bill has been getting paid on now for about 2 years, and it's down less than $1,000. So you can see how the interest adds up, and when you pay interest on interest, it really can take you a long time to pay something off. The minimum payment will be 8 years on this, and you'll wind up paying over $4,000 more than what you started. So interest definitely costs. And when those costs add up, they add up pretty quickly. So this is that same bill, but as you can see, in just 2 months, almost $170 has been paid in interest so far on a 14% loan of $8,000. It's crazy. And you can see here, man, we talked about it being calculated daily. This is the daily rate. This stuff doesn't look like much, but it adds up quickly. And if it's compounded, it adds up even quicker. But what if you could add up the same way so that you could make more money instead? Most of us think that only the banks can charge that kind of money. So what if we could do something different? This is just a quick example of how compound interest can work in our favor. So if you had the option, would you take a penny double for 31 days and get the total sum of that money at the end of 31 days, or would you like $1 million now? If you've been watching this video, you probably can determine which one is more like compound interest, and you can see the difference here. So day 1, you have, of course, 1 penny. Day 15, you now have $163. Doesn't seem like much, but if it keeps doubling, compound interest-wise, at the end of 31 days, you'll have $10 million. So you have over $9 million more than what you would have had just 31 days prior. A little bit more of an example that makes more sense is you can see that banks use something called MPY. They don't offer it to you, but they get it because they actually trade your money in the markets, which is why you get a small amount of money for loaning it to them. With this example, if you had $200 invested at 8%, but if you got a monthly interest return of 8%, this is what it would look like. It would look a little bit more like the penny, okay? Traditional investments are 12%. That would be really good for the whole year. But you would actually only have about $40,000 at the end because there'd be other fees involved. And you're only getting that percentage for the whole year. So really it'd be like 1% a month versus 12%. Where this example, you're at 8% for each month. And that can add up to $2 million in 10 years with just one-time $200 investment. So what do you need to know about compound interest? More time equals more money. Time equals periods of growth. So yearly versus monthly. Monthly is going to grow a lot faster, okay? Everyone already invests. As I mentioned, the bank is investing your money, but we also all invest our time and energy as well. So are you earning interest or are you just paying it? And are you taking advantage of options that allow you to be able to grow your money on a monthly percentage rate or just annual? And it's really not about how old you are. You can really get started today. It's only concerned with time. These calculations don't have anything to do with your age. You can make up for some of the years that you've lost. Of course, the younger you are, which means the sooner you get started, the sooner the better. Even if it's just $50 a month getting started investing, the more money you can put in, the more time it gives you back. So get started now. Again, we talked about, is it magic or mystery? Can you really become a millionaire? You've seen compound interest over time. You can actually become a millionaire. And there was a really smart man who said it's the most powerful force in the universe. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So I hope that this has helped you to understand it a little bit better and hope that you begin earning it instead of just paying it.